maybe we'll begin with that economic data today. We got PPI, Amy, we got jobless claims. Just interested in your bigger picture on the U.S. economy, Amy, where you think we are and where we're headed.
Yeah, Josh, thank you for having me, and Julie, thanks for having me as well. I think, the economy continues to hum along. We are certainly at a point where the surge of purchases, whether it's services or goods, catching up from 3 years of lockdown is well behind us. And so going forward, we are starting to see that the consumer is moderating. We are starting to see, just the general breadth of the market, health of the market is moderating. We're seeing those cracks in the labor market as well. I'm not necessarily calling a recession, but certainly we are seeing a healthy moderation. And I think it's all normal with regards to, again, what we've seen over the past couple of years post-COVID. And now it's just a normalization of some of those trends.
So when you just heard Josh talking about that Nick Timmeros article where he talks about it's still kind of a toss-up between a quarter point cut and a half a point cut. Do you think that's true, or do you think it's pretty much going to be 25 basis points at this stage?
My personal take is that it would be a 25% cut coming in the next FOMC meeting for a couple of reasons. The data that we've been seeing does not necessarily call for 50 as an initial cut. And at the end of the day, let's zoom out a little bit and think about the up cycle that we saw where the Fed has started with 25 and then ramped up pretty quickly with 50 and 75 basis point hikes. That is, in my opinion, an admitting of they were behind the curve. And now we're at the other end of the spectrum where the Fed is now going to lower rates. I don't necessarily think the Fed is at that point where they're thinking that they're behind the curve, and also thinking about the messaging that we've been hearing over the past several months. It has been pointing more towards a 25 basis point cut as opposed to 50. So again, all those reasons combined together, it makes me feel that a 25 basis point cut to start the cycle makes sense. Of course, the data can dictate whether or not a 50 basis point cut could be in the cards.
If they did the traditional 25, Amy, next week, what would you assume the kind of pace of cuts could look like after that?
It's a great question, and I think it's really data dependent. So as I've mentioned just before, I don't necessarily think the Fed believes they are behind the curve. And so as long as the labor market data points, retail sales, you name it, all of that still suggests that the market is still in an okay position, the Fed is probably not rushing to cut in a 50 basis points increment. And so they probably have a little bit of flexibility to do 25 basis points at a time until, again, the data calls for it.
So, we've all been obsessing over this rate cut, of course, but let's look past it if we can and look to what potentially could be the next catalyst for the market after the rate cut. Is it going to be a refocus on earnings? Is it going to be more attention than refocusing on the election that's coming? What do you think?
Yeah, I think the first couple of rate cuts, whether it's maybe 100 basis points, could be just a normalization of the monetary policy that we are seeing today. The reason why we're at where we are today is because we saw CPI data points, PPI, you name it, at very, very high levels almost a year ago. The environment today does not call for such a restrictive policy. And so after the first 100, let's call it, in terms of interest rate cuts, the question to your point, Julie, is what's the market going to focus on? Is the next 100 going to be a function of, well, the economy is not going to be so sustainable, that's why the Fed's cutting some more? That's a really, really important question. I think earnings continue to be a very good support for the system because that is exactly why the markets are still trading at the valuation levels that we're seeing today. And going into 2025, estimates are still calling for a 15% growth rate in terms of corporate earnings from 24 to 25. And much of that is still coming from the tech companies, Mag 7, some of the AI-driven companies to your earlier comments. And so as long as that continues to be the play, I think market conditions, or rather stock market conditions, continue to be in a favorable place.
Well, what's the risk, Amy, to that outlook for corporate growth and margins?
Absolutely. I think the estimates, as we call it, they're estimates, right? And so as long as they continue to be matched, that's great, but certainly the conditions can soften, and you wouldn't expect anything to be a straight line up. I think there could be some ebbs and flows. There could be more competition to certain, semiconductor plays out there. And so any of these headlines could dampen the outlook for earnings going forward. I think one thing that's also worth mentioning is that the estimates for profit margins continue to be on the elevated side. And that's something that I'm watching quite carefully because I want to make sure that, can companies still raise prices in this kind of environment? We've now gone through 2+ years of raising prices, pulling levers to cut expenses. Are we at a point where we've reached a wall? And that's really important as we're thinking about the expectations for profit margins over the next couple of quarters.
Yeah, and you're in a weird position if you're a bull who wants that to continue because you don't want to pay more, you don't want to keep paying more, but you want profitability at companies you own to keep going up. So it's a tricky situation. Amy, thank you so much for being here.
Thanks so
Appreciate
much.
it.